Let's really drill into those U.S. inflation numbers. Of course, inflation coming in higher than people had expected for January. We're joined by Benjamin Tal, Deputy Chief Economist at CIBC. Benjamin, your colleagues or your team over there saying that this will not cause joy for the Federal Reserve. But are these numbers, they're not that bad, are they?
No, nothing in life is linear. People expected the inflation to go like that. It goes like in a zigzag. So we have a little bit of a surprise on the upside surprise. No big deal. The trajectory is very clear. It's down. It's slowing down. The U.S. economy will slow down over the next 6 months and inflation will follow suit. So this number is not changing the direction. It's just adding a bit of complication and makes the life of the Fed a bit more difficult. So it's not easy, but at the same time, it's not a disaster. So the point here is that we are seeing a situation in which inflation will continue to trend downward towards the target by 2025.
And we are seeing some disinflation, core goods prices. Are prices dropping in any area? I know they have been in China, for example.
Yes, goods prices actually are going down because of the fact that supply chain is normalizing. And we also had a significant decline in used autos prices because of methodology. They basically changed the way they measure it. So that added to 3.6% decline in the price of autos. So that was a significant part of the story. And that will continue over the next few months. So you have a tug of war between goods down, services up. And the Fed is trying to figure out where we are going.
But you guys think the Fed is likely to be comfortable cutting rates in the second half of this year, but you're not looking for much in the way of cuts before July?
No. I think that the Fed will wait. They have to make sure that inflation is absolutely dead. The one thing that is not happening is shelter inflation is not easing. The Fed is expecting shelter inflation, which is a major factor, to ease, and it's really not happening. In fact, the opposite is the case. Now, remember, the Fed is focusing on the PCE, not the CPI. The PCE, the shelter, is only 15%, while in the CPI, it's about 33%. So clearly the CPI and the PCE are disconnected because of shelter, and that's why the acceleration in inflation in shelter is not as significant for the Fed because their focus, again, is the PCE, not the CPI.
And the PCE is the Personal Consumption Expenditure Index, and that's the one the Fed likes to monitor.
Exactly, you got it. And that's exactly the story. The story is that the weights are very, very different. So when you look at the CPI, they get a lot of media, a lot of highlights, but at the same time, what the Fed really cares about is the personal consumption expenditure, the PCE, and here the weight of shelter is relatively subdued, only 15%. So it's not a game changer if shelter prices accelerate.
Let's get on to productivity. Now, often when an economy's expansion gets long in the tooth, employers hire less efficient workers, productivity goes down. What's been going on with U.S. productivity?
That's exactly the story. We have to remember first that productivity is a big shelter of inflation. Namely, if I give you a 10% increase in your wage and you're 10% more productive, that's not inflationary. So as long as productivity is rising, and it has been rising nicely in the US, it really protected inflation. So inflation could have been much worse in the US if we didn't have productivity. Now, unfortunately, in Canada, we don't have the case. We know that productivity is actually negative, and that's a major issue. Now, what's happening in the US over the past few months is very interesting. The labor market is still tight. But if you look at the quality of employment, the composition of employment is going down. Namely, as you mentioned, in the late stage of the cycle, you hire more and more low wage, low productivity people. So productivity tends to follow employment quality. And employment quality is actually trending downward, which means that productivity growth will slow down in the US, the only protection from inflation. So we need to see the US economy slowing down, demand slowing down, service inflation slowing down, because you don't have the protection of productivity anymore.
What do you mean by employment quality?
It's basically the share of low quality jobs in the labor market, and low quality here is defined as simply below average wage. So low wage jobs, we see the share rising, and that's very typical for the late stage of the cycle. And productivity, if you look at the chart I hope you have it, you can see that there is a clear correlation between the quality of employment and productivity is lagging behind the quality of employment, and the quality of employment is already down, so we know that productivity will go down. That will remove one element of protection from inflation.
What about in the United States? We've had a lot of, actually start with Canada. We've had a lot of controversy over these foreign students coming in. Critics of the program say they're not really interested in getting trained here. They just want to get into Canada as immigrants. The government is curbing it. Have they been a big factor in our labour market, this supply of cheap labour?
Absolutely, and we are underestimating the number in a very significant way. So I think that they have been playing a significant role in lowering wages, because it's basically cheap labor, and preventing and protecting businesses from raising wages and productivity because of that. So I think that the latest policies regarding capping the number of non-permanent residents in general and foreign students in particular is a very good move in the right direction for housing affordability, but also for a more productive labor market.